Hello, welcome to the Bitcoin Standard podcast. Our guest today is Lyn Alden, the author of Broken Money, out now from the Safe House. You can get it along with my books, as well as Fiat Food, Gradually Then Suddenly, and now the Bitcoin Enlightenment from thesafehouse.com. And Lyn has also recently coined the phrase, nothing stops this train, to discuss the fiscal situation of the United States government. And I thought it would be good to bring her along to discuss this. We've had Lyn over, I think, twice before, or three times maybe even.
Something like that. Yeah.
Yeah, something like that. And it's always fun to catch up on what is going on in the broader macro world and find ever newer ways of arriving at the conclusion of why Bitcoin. So let's do it again. Welcome,
Happy
Lyn.
to. Thank you. Thanks for having me.
All right. So, we were just in Vegas a few days ago. We met during the Bitcoin conference, and you gave a talk titled Nothing Stops This Train. And I thought it was a very interesting talk. And I think beyond just the usual fiscal doom and gloom, there's a deeper thesis there. Do you mind telling us a little bit more about it?
Sure. And I think there's been like two phases where I've covered this. And so starting back in like 2019 and particularly in 2020, I started to emphasize the sheer fiscal activity that was happening. And some of that was happening before the whole lockdown pandemic situation, but then obviously it went into overdrive in 2020. And one of the things I was doing at the time was pointing out that this was very different than some of the mechanics we were seeing back in the global financial crisis. This wasn't just, say, QE for like bank recapitalization. This was actually basically QE to monetize unusually large fiscal deficits that were actually getting out into the broader non-banking system economy. And so kind of my view at the time was this has very different implications. And then as it continued, the implication was this was going to be inflationary for prices, not just money supply. And so that's been a key part of my investment thesis. It made me bullish on a number of assets. I had big debates with kind of like the bond bulls at the time. They were saying, no, this is not real money printing. It's going to be disinflationary still. And so that was kind of my whole endeavor back then. And I started using the phrase "nothing stops this train," I believe around early 2023 or so. And that was because we went through this very, very brief window where we had a narrow fiscal contraction. So in 2020, 2021, that was like the crazy money printing years. 2022 is when they really tried to hawk it up. They tried to, they raised interest rates. They Most of the kind of the pandemic era programs were like over dialed back to some extent, and so we saw this contraction in the broad money supply. We saw this contraction in private credit. We saw this reduction in public deficits. But by kind of late 2022 or early 2023, as public interest expense ramped up, federal interest expense on the debt, we actually started to get rising deficits again, even though they were still trying to be hawkish. And so that's when I kind of emphasized that we are entering like kind of another cycle now of where fiscal's leading again, less explosively than that whole 2020 and 2021 period, but more persistently in the sense that it's not tied to any one catalyst. It's not this like one thing that's happening. It's back to the broader trend now on steroids. And so my key kind of emphasis was kind of fading some of the disinflationary themes or even some of the recession themes, and instead emphasizing that when you're running 6 or 7% deficit of GDP, that's a pretty different investing environment and a different economic environment than many people are used to outside of a recession. And that has all sorts of implications. So I've been kind of pounding the table on the power of fiscal before the pandemic, during the pandemic, and now even recently after that whole period.
Yeah, and I think it's really a combination of factors all coming in together. The demographics, plus all of these new things of all these new ideas for spending that came out after COVID, and defense ramping up as well. All of these major things, they're just all coming up at the same time. And as you say, the perhaps the most significant factor is that this is coming at a time when interest rates seem to be rising. And every time before, there was a constant decline in interest rates that continued to make the growing burden of debt appear lighter and lighter and lighter. Over time, it would look like it's the interest expense is declining because the interest is declining. So growing debt doesn't sound like such a terrible idea. But now the interest is increasing, and therefore the debt servicing is also increasing.
Yeah, a lot of these things are happening together, which is why it's so persistent. It's a really big Gordian knot, and that's why I keep fading any attempts that they're gonna, claiming that they're gonna get back on track. I mean, earlier this year and kind of late last year after the election, there was this big idea that Doge and Elon Musk are gonna get this back on track, and I was just looking at the math that's saying it's almost impossible. There's very little that they're going to be able to tackle that will actually get this back on track. So one, demographics. Basically, for decades, the baby boomer generation, which is very big, was paying into the system, and now that they're effectively retired and increasingly retired as the years go on, as even the youngest baby boomers start to retire, they're now in big drawdown mode. And so over the next 10 years, the existing 3 trillion in the Social Security Trust, which is held by intra-government debt, it's kind of the wonky accounting that they do, but that's going to basically pour back into the economy and transfer to external debt. And that's spendable income that enters the broader circulating economy. Then there's the interest expense. So for, like you said, for 40 years we had rising debt to GDP but falling interest rates. And right around the same time the demographics started to roll over, we hit zero interest rates, bounced off zero, and now we have rising debt to GDP but no longer declining interest rates. So you don't even have to assume that interest rates are going to go up. If they just kind of chop around sideways for the foreseeable future, interest expense starts becoming a very meaningful percent. It just passed defense. It's now like the biggest component after Social Security. And if it keeps going, it'll eventually pass even Social Security. Defense spending as a percentage of GDP was falling for a while as we kind of exited the Cold War. But a lot of things, the kind of theme is things don't have to ramp up rapidly. Just if you have a mild trend change, that can really matter. So if you go from shrinking military spending as a percentage of GDP just like flat or mildly up, that's a trend change. That really makes a difference in some of these marginal numbers. U.S. has the highest healthcare costs in the world on a per capita basis, and so that's a whole topic in and of itself that's very hard to unravel. So people often point to Japan, but Japan, despite being on average 10 years older, has much lower healthcare costs per capita. They live longer. A lot of factors there. But the United States has, the other part of retirement spending besides Social Security is the whole Medicare spending and the broader healthcare industry. And so basically for 10 plus years, basically any sort of investment horizon that anyone can plan around, the deficits are virtually unassailable. And then the kind of the punchline, which I didn't get to at the conference, but I've written to before because it's a somewhat of a longer topic, is that compared to many other developed countries, like let's say Germany or Canada or whatever, the United States' tax receipts are more closely tied to its stock market performance. That's partially due to the fact that we're a global kind of hub for equity capital, that the whole world wants to invest in our equities. It's partially because we have higher wealth concentration than many other developed countries, and it's partially because of our nuances of our tax code. And so basically, when you if they even if they actually do a pretty good attempt at austerity, when you kind of fast forward 12 months or so, it'll be like a recursive thing where now their tax receipts are suffering because of the way they structured things. And so nothing short of a kind of complete overhaul would even get close to tackling this. And there's nothing on the cards for that politically.
Yeah, it seems very convincing. One perhaps counter argument here would be, well, maybe interest rates can go down. I mean, CPI has been relatively okay for the past couple of years. It went up in 2020 and 2021 during COVID, and then it came down. They won the war against inflation, as Paul Krugman says. So maybe they can bring interest rates down now, and then that's going to reduce the debt burden and perhaps also serve as a growth stimulant so therefore increase tax revenues. What do you think?
So I think it's possible, and that's, I mean, when I kind of at the conference, my last slide was highlighting that they've been in a similar situation before, which was the 1940s. And historically, how they and other developed countries got out of this was financial repression. They held interest rates low despite the fact that inflation was happening. And then back then, they also had very strong demographics, and they had this productivity boom, both in the U.S. and like Japan after the war. There were multiple places that had a productivity boom, and they were able to combination of grow out of the debt and inflate out of the debt, even as the nominal debt never really went down and eventually started trending back up again.
Yeah, but also I should say, like, also one other factor in the 1940s is that they managed to find a very large number of bag holders for dollars after World War II. That's what Bretton Woods was about. All these countries shipped a lot of gold to the US and took paper from the US, and that improved the fiscal situation of the US significantly. But yes, you're right.
Yeah, that's part of the inflating away component. They basically, that's the bag holder component, and some of that was tricking people into it, and some of it is like force. Like in America, they banned gold ownership, which is crazy. For like 40 years, Americans could not own gold, and there were other things that just kind of stuffed capital in place. There's also banks. An unusually high percentage of their assets were treasuries because they were kind of forced into like these public utilities. They were basically there for holding treasuries for a period of time. That was kind of that was like another offset. And so as we look forward, let's say they do cut interest rates, which is certainly possible. If we have, for example, you know, pretty rapid gains in say AI, keeping white collar wages not growing very quickly, and kind of a productivity boom from there, and kind of the way that they choose to measure CPI is not particularly going up very quickly, which gives them levers to kind of cut interest rates. That's certainly possible, but then it just goes back to, you know, you still have the other component. You still have the Social Security component. You still have the Medicare component. You still have the defense component. You still have that whole complex. Interest rates are one of the key factors. But then it goes back to also the prior point of it's a trend change. So even if interest rates don't keep going up, or even if they don't stay at the level they are now, and the important thing is they're not falling anymore. Even if interest rates go back down to say 2% on the short end and 4% on the long end, or whatever the case may be, that's still not an offset. It used to be an offset to the rising debt levels, and now it's just kind of in the static range potentially. And then in addition, if you do get a much lower interest rate, right now there's this kind of like there's still a hawkishness behind the dollar. So there's a lot of developing countries out there that have dollar-denominated debt. It's something like $18 trillion in dollar-denominated debt. I think of which 13 is like held by non-banks, and the rest is held by banks. That's in developed countries, that's in emerging markets, it's kind of all blended. That's part of the Eurodollar system. And all of that represents inflexible demand for dollars. So when the dollar gets kind of strong, it squeezes them. If we do get a much lower interest rate on the dollar, that allows a lot of those other countries to ease their monetary policies as well, because they're not kind of struggling against that strong dollar as much. You potentially get kind of a BRICS boom, or like an emerging market boom cycle. You potentially get higher energy prices from that. Right now, because of the more sluggish global economy, it's one of the factors keeping oil prices pretty much in line. And so that's another factor that can kind of happen. And then at the conference, I highlighted that gold and other scarce assets tend to have this inverse relationship to real rates historically, which is, if U.S. money supply is growing at 7 or 8% per year, most people aren't looking at that. They're looking at CPI, but still, it's growing at a pace. If they feel like they're getting paid 4 or 5%, they're more willing to hold on to that, especially in this kind of regulated environment they operate in. But if they're getting paid 0, 1, or 2%, and that money supply is still growing, they're more likely to get into gold, or in our case, Bitcoin. And so even if we get this kind of low interest rate environment and deficits slow down a little bit, that's still really good for the assets that I'm talking about. And so that's kind of the wonderland snare we're in now. Whereas higher interest rates have one mechanism of accelerating this, and lower interest rates have another mechanism of accelerating this, because it's kind of less of a free lunch now than there was during the structurally declining interest rate environment.
The Bitcoin Standard podcast is brought to you by thesafehouse.com, my independent publisher and bookshop, selling the best Bitcoin books in high-quality cloth hardcovers built to last for generations. Most books these days are pretty fiat. They're flimsy and they fall apart quickly, and I did not want that for my books, so I set up the Safe House especially to provide you with beautiful, long-lasting classic cloth hardcovers you can proudly pass down for generations. You can get copies of my 3 books, the Bitcoin Standard, the Fiat Standard, and Principles of Economics, and you can also get copies of Lyn Alden's Broken Money, Parker Lewis's Gradually Then Suddenly, and Matthew Lysiak's Fiat Food, to which I contributed a few chapters. We now offer bulk discounts so you can buy books for yourself and for the friends and family you'd like to learn about Bitcoin. Buy any 2 books for $50, any 5 books or more for $20 per book, and for more than 50 books, it's only $15 per book. Go to thesaifhouse.com, the SAIF house.com, where you can get all of these books in high-quality cloth hardcovers, delivered worldwide, and get 10% off for paying with Bitcoin. The Bitcoin Standard podcast is brought to you by the Daylight Computer. I love to work early in the morning and late at night, or in the sun outdoors, but regular computer screens are terrible at these times, and they strain your eyes. For years, I've wanted a paper-like electronic screen on a simple computer I could use to write. I tried several models, but none were very good. Now, finally, Daylight have delivered a fantastic full-function tablet with a paper-like screen that's easy on your eyes and great for outdoor use. I've been using the Daylight Computer to write my next book, and it is absolutely fantastic, and it has led me to invest in this company myself. Check out my interview with Anjan Kata in episode 249.
Yeah, it's difficult to see how you could get these things to favorably align in a way that can avert this kind of problem. So the way out is, in my opinion, the way that I see it is default devaluation or default by devaluation, some combination of these scenarios. Would you agree?
Yeah, I agree. And in developed countries where the liabilities are in their own currency, it's almost always the devaluation option, which and I consider that a default as well. Basically, if you massively devalue bondholders on a purchasing power basis, then that's a type of default. And basically, when you kind of kick, we've gone through this cycle. We keep building up private sector debt. Then it gets so bad that they transfer a lot of it to the public sector. They kind of have this kind of rotation that happens. And when it's all in the public sector, there's really nowhere else for it to go other than default. And if you're an emerging market, you often default nominally because you really just can't acquire the dollars that you pay back, much like a private corporation. Whereas if you're the United States government, you print the difference. And depending on the level of productivity, that will affect how much bondholders even realize that. Because, for example, during the 1950s, 60s period, bondholders weren't exactly complaining, and yet they were underperforming basically anything else. So stock market was going up, most other asset prices were going up. Bondholders and currency holders were the bag holders. Whereas in the 70s or in the past 5 years, when you have more productivity challenges, the bondholders feel it more. And so it's not basically if there's bad productivity, the bondholders can underperform even basic goods like energy prices, for example. If there's really good productivity, they'll still massively underperform like high quality financial assets that have scarcity to them. Things like gold, Bitcoin, art, best high quality real estate. It still kind of underperforms the things that we're not getting more productive in making. Because there's that big spectrum in terms of things that are actually scarce versus things like electronics or textiles or whatever the case may be that we're getting radically more productive in making over time.
Yeah, and do you think well, this was the topic of my presentation in the conference, which is on demand for Tether, and I thought. I ran some numbers on what I think would be the fiscal impact of Tether. So based on the research that you get on, say, QE, generally, which is the most the topic that was the most studies, they have some estimates about how much you can move the yields with purchases, and the answer then was, when the debt was in the range of around 10 trillion, then it was around 1 trillion of QE could move interest rates by about 0.2 to 0.5. So that was about 10% of the debt. If you could QE 10% of the debt, then you could bring yields down 0.2 to 0.5%. So I took that as a frame of reference and tried to project that on Tether. Now we have obviously a bigger debt now, so you need a bigger purchase proportionately. So I projected, I took a higher end to try and overestimate the impact. I projected if we did one percentage point decline per 10 percentage points of the debt, what would be the impact? And then I assumed that Tether would be growing at around 60% per year over the next 10 years. So it gets to around $20 trillion in 2035, which is huge. That's an enormous growth. And I think it's quite unrealistic because there's a lot of dollar out there, and a lot of Tether's growth is going to be displacing some of the other dollar-based instruments that are already out there. So it's not all new. But so if we did 20 trillion, and then if Tether got to 20 trillion, then I think in terms of the impact that it would have on the debt by 10 years' time, it would make about 3.7 trillion difference. So the debt would be, instead of being about 69.5 trillion, it would be 65.7. That's basically it. This is in this scenario where Tether debt purchases grow enormously and they have a significant impact that they bring down yields by 1%. They'd reduce the cost of servicing the debt for sure. But the magnitudes involved are so enormous, and the market for money outside of the US is already got so much dollars in it that I don't see, even in the most optimistic growth scenarios, there's just not that much room for bag holders. It's not 1945 anymore where nobody had dollars outside of the US. Now everybody's swimming in dollars already. So yeah, they can always buy more dollars, sure, but it's not going to make as much of a difference as in 1946 when they were going from very little dollars abroad, right?
I agree with you. So I don't think stablecoins are a magic bullet. I listened to your talk. I think the best point in the talk that I heard was that it displaces many other types of dollar holdings. It's not all new. Now there's some new, but it's not like all new because right now existing currencies are partially backed by dollars, treasuries, and that sort of thing. And to the extent that you undermine that and give people dollars a little bit more directly, more pegged, it depletes that other one. Now it is pegged at a higher rate. So if for example, let's say a given developed market currency, so let's say 20% of the money supply is backed by treasuries by the central bank, and instead those marginal holders switch over to holding stable coins that are backed 80% by treasuries or whatever the case may be, that changes the ratio. And so basically what it does is it transfers seniorage from other central banks more to the US. So I view it less through the interest rate channels being effective because like you said, I don't think that it's going to like materially massively change interest rates. Around the margins it can. That's not the big avenue. I think the biggest avenue is that right now there's all these borders that kind of in some ways try to prevent people from getting dollars because there are a lot of people that would like to have more dollars than they have now. There's, if you think of the two ways to get currency in and out of a country, one is physical borders, which are obviously highly surveilled, policed. You can't easily bring large amounts through them. And wire transfers and even fintech stuff is just basically an overlay on top of banks talking to each other, and they can control that. They can control what the exchange rate is if you try to transfer dollars in. They can control whether or not the people that have access to banks can even get dollars. And what stablecoins do is they kind of go around that because by memorizing a few words or writing them down, you have this higher density of getting value in and out of a place, either physically or with a QR code over a video call. So it allows more access to dollars, which gives people in those countries more ability to get them that otherwise had frictions. But that's still got limits to it. And there the whole world is kind of already pretty aggressively in U.S. assets, and then especially when we're talking big pools of capital, a lot of them are in equities, a lot of them are in bond markets, a lot of them are in private equity in the U.S. It's not really, going into that market. It's mostly going against the smaller market, which is basically currency and the existing central bank seniorage. So it's not that it makes no difference, but that it's not some magic answer. And I think what we generally see is politicians, they like to point to magic answers when the math doesn't really work. It's like one of the magic answers historically was basically productivity growth. That sure, this bill that say cuts taxes and raises spending at the same time, and sure the projections are that it's going to increase the deficit, but they'll say, well, we'll get so much productivity growth from this bill that the deficit will work itself out, right? And that's one of the magic bullets they'll point to. And the stable coins are kind of the modern day thing that some politicians I think point to say, well, maybe the math doesn't work, but if we pursue this, we can at least kind of make the runway go longer, marginally increase the demand for dollars, and then by extension treasuries, and just kind of, it's mostly about that backing ratio shift to the extent that these are able to penetrate into those economies more than physical dollars have historically been able to.
Yeah, and I think a lot of it is competing directly with physical dollars. People who use dollars in developing countries, a lot of it used to be physical cash, and now they're using USDT. And then a lot of it is competing with financial instruments that are ultimately backed by dollars, although at a much lower ratio. But still, at the end of the day, the total M0 around the world is only about $15 trillion. That's total global M0, and the US dollar is only about half of that. And then the rest of the M0, the rest of the world's monies, the foreign reserves of the rest of the world are about 60-70% US dollar, I think. Last I checked, it was in the 60s, may have dropped recently, but still, about 60% of global currency reserves are in dollars. So there's just not that much room for more and more bag holders to come. And I think you're right. It's one of these ideas that just sounds very good when people are desperate to sell them this kind of, just like, with tariffs, that foreigners are going to pay for everything. We could just put 140% tariff, and then, the producer will pay you triple the price of his product for the privilege of having you consume it. They'll just eat it, right? And then we'll have our cake and eat it too.
Yeah, we've already seen the narrative shift there. I mean, a lot of those foreign producers, I mean, these are not software companies, they're hardware companies. They have profit margins that might be 10, 20, 30%. They can't just absorb a double-digit tariff and just kind of take it. And so we've already seen the narrative shift from foreigners are going to pay it to politicians saying they're going to make sure that American companies are not raising prices to try to get them to absorb it. And it's like, well, why do we have to do that if the foreigners were going to absorb it? And so, yeah, these things have real costs. Politics is always about optics games. And I think the final point on stablecoins is that it's less, I view it less about getting the number of dollars out there. It's partially, it impairs in some ways the exchange rate between the dollar and other currencies, and kind of the thing that can happen is let's say you have this kind of country with an increasingly impaired currency. It's a developing country. It's got, say, 20% dollar backing for its currency. Early adopters that, say, previously had trouble getting into dollars due to border restrictions and other things and bank restrictions, to the extent that stablecoins allow them to get into dollars more than they previously could, earlier adopters that do that benefit, because as people get out of that local currency and get into a more backed version of the dollar, the other ones potentially are the ones that are transferring purchasing power to the ones that got into stable coins earlier. Now, the same is true for Bitcoin. The same is true for any other scarce asset. And it just so happens that currently the biggest two ones, Bitcoin and stable coins, are ones that give more access to a lot of these countries than other that they previously didn't have. So a lot of these countries, they already had access to gold in many cases. They often use local real estate as a kind of a placeholder for value, something more scarce than the local currency. And Bitcoin and stablecoins mainly have the advantage that over a video call or a DM or even transferring value through borders, there's greater density and ease of access there. And so the biggest losers are the ones in those countries that don't transfer over to better monies once it becomes available for them to do so.
This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.
Yeah. And I think the same dynamic eventually is going to apply on to Bitcoin. I think we're going to see probably a fight to the death between fiat currencies as they one by one continue to sink thanks to their inflationary and fiscal monetary policies. But eventually people are going to start realizing this. I think even though in the 20th century we had a lot of hyperinflations, I think for most people who suffered through these hyperinflations, it was never as transparent as, say, the current shitcoin market is, in that you could just dig up charts very easily and very quickly online at any point in time and see exactly how much you're getting rugged. It was a lot more complicated, historically. When people go through hyperinflation, generally there's just so much other stuff going on that for them it's the hyperinflation itself is almost always in the background compared to the prime minister was assassinated or a part of the country broke off or the civil war started or something like that. So they can't really they don't really identify the cause and effect between the inflationary monetary policy and the excessive spending by governments and the collapse in the currency. And for most people, most of these periods, their access to other currencies was relatively limited. There was their currency and then there was the other currency. And so for many of these people, often they think of it not so much as our currency collapsed, it's the dollar shot up. Something happened to the dollar where in our country, out of all the world's countries, for some reason it became very expensive. You'll be surprised, but people still think of this in these terms until today. But I think the more interconnected the world becomes, and the more accessible these alternative currencies become, things like Bitcoin and stablecoins, the more it becomes easier to just dig up a website and see the performance of one currency against another. And then you'll start really getting what's going on. You'll see that, that all these currencies are constantly getting devalued against the dollar, and the dollar itself is getting devalued. And I think more and more people are going to notice this just because it's going to become more and more obvious and more transparent because of, internet and information and charts and people talking about it on social media all the time.
I agree. Yeah, the last time that, even if you go to developed countries, last time they went through financial repression was basically the 40s and 50s era. Information traveled way slower, especially information between people. Like there wasn't from the top down big sources. Information between people was much slower. Things like physical newsletters and magazines and stuff, and now it's social media, now it's websites, and so all this information can flow around way quicker, including across borders in most cases. And so this is the financial repression that we can meme about in real time that people couldn't do back in like the 40s. And so it's also the case where if you have like a long-term issue that causes something, people there's less things that say politicians can point to that are convincing to people. So, for example, in the United States history, the financial repression partially worked because they created this like we're all in this together environment, like buy bonds to support, this, and we're fighting the Nazis and that kind of environment. Whereas if we're in the same debt situation we are now, as we were back then in terms of debt to GDP, but this time it's because of decades of mismanaged entitlement math and stuff like that, and foreign wars that trillions of dollars were spent on, and then there's no gain from it. That type of accumulated, basically, entropy in the public ledger is way less easier to justify, way less easier to distract people from. And so the combination of faster information and less acute reasons for how they got here has its effect. It's kind of like how during the initial inflation surge, people were saying, well, this is a supply chain issue. But then when we kind of fast forward many years, the prices are still elevated. We're still above their inflation targets. Prices never go back down for the most part to where they were, because it's inherently about the money supply growth, not about the supply chain issue, even though in the near term, supply chain issues, of course, matter. And people start to notice that information moves quicker. And now people, they have more options to get out of the weakest things and into the strongest things.
Yeah. And we know what the strongest thing is.
Bitcoin.
Exactly. There is no second best. And people are just going to realize it. I mean, there's no escaping it. The Bitcoiners are just not going away. They're going to keep imagining one day this Ponzi is going to crash, but it's not going to happen. It's not going to crash. And it's just going to keep going up. And eventually you're going to have to adjust your mental model and join the orange train.
Yeah, it's it's kind of like, and I think the problem is that there's so many things that people kind of have to get, like the hurdles they have to go through to get that. One is like, can digital things have lasting value? That's one of the hurdles people get through. Another one is, okay, so if digital things can have value, what prevents all of these from having value and depleting the supply? So then they have to kind of see why network effects and self-reinforcing scalability really matter. And then they have, so there's like a number of steps that people get through. I mean, that's partially why we both do what we do, is to kind of educate and share what we research along the way, to try to be part of this information trend. So as information gets more, easily out there, it still relies on people doing work, doing research, and sharing it with others, to say, here's what's happening. Here's, okay, here's arguments I'm seeing. Here's answers to those arguments. And over time, people get it. And another point that I made is, like, people can see one or two bubbles and dismiss them. So if they see kind of Bitcoin rise and collapse, like, oh, the bubble's dead, they don't necessarily go look at the log chart and see that there's been a couple bubbles. They only can really often know the bubbles that they saw. And the first really public bubble was 2017. Then there's the whole second bubble, but then people could be like, well, that was COVID, that was the money printing thing. So we got this kind of second aftershock, and people were able to dismiss that. But now it came up a third time. So this is the third quote unquote bubble that has been in the kind of the public realm, with the prior ones, the prior bull markets, being kind of sub public level. And people can't really ignore things more than 3 times. I think that's kind of the magic number, where it's not an accident, it's not a fluke. Maybe I should actually pay attention to this thing. That's certainly what happened to me. Just forward it a little bit. Like, I would see Bitcoin have a cycle, one of its early cycles, and say, that's neat, it's cool. And then I kind of forget about it, and then it has like another bigger cycle, and I'm like, oh, that's actually still here. And then it kind of goes through a bear market, and it goes to the third cycle. I'm like, okay, I'm not going to mess this one up. So I finally figure it out. And I think that's the important thing, is that that's now basically happening in the public realm, where we now have 3 cycles that are all relatively public.
Yeah, and it's been in. I mean, there were all kinds of financial instruments allowing people exposure to Bitcoin even as early as 2017. So it's been on most people's tickers and Bloomberg terminals since 2017, and here we are, and this is the third pump. And yeah, I think it's going to continue to get harder and harder to be a hater. But what are your thoughts on all of this tariff brouhaha that has been taking place? How do you see this unfolding?
Generally in things gradually backing down. It's been a big subject of my macro analysis because I publish reports every 2 weeks for clients, kind of going, what's happening, what are the risks, what are the opportunities, and that has taken up kind of the bulk of the macro section, just because there are really Boolean outcomes there. And like I invest partially in private markets too, and like there are companies that are just frozen in indecision because they might have a Chinese supply chain, and it's like, well, should we try to retool this and put it in the U.S. and ironically lower the quality because they're like, we can't even find U.S. manufacturers that make this the same way, so we'd have to like simplify the product in a negative way, and it's more expensive. And imagine we do all that, and then there's some sort of tariff change where the tariffs go away, and it's like our competitor that didn't do that and just kept their Chinese supply chain is ahead because they didn't spend money retooling everything. Or if we sit down and do nothing, what if these things don't change, and basically our margins are wiped away and we're kind of operating at a very high level? So there's a lot of companies that are just their default is run more conservatively because we don't know what things look like 6 months from now in terms of margins, in terms of our ability to make long-term contracts with our suppliers. Kind of like how inflation disrupts productivity because it's hard to make contracts and you have to make shorter term, more conservative decisions with things. Tariffs have essentially the same impact, which is it's harder to make long term optimal decisions. So everything's shorter and or frozen. So yeah, pretty negative on that. It's also, people have often asked what can make Bitcoin and the Nasdaq kind of decouple, because a lot of people say Bitcoin's just like levered Nasdaq. Basically, they go up together, they go down together. I would argue a lot of that has been due to the liquidity correlation. But one of the things that can make them decouple on a more persistent basis, like let's say you have a 5-year period where Nasdaq is chopping along sideways and Bitcoin is up significantly, would be the margin impact on U.S. corporations. So if you do get kind of an environment where liquidity is pretty good due to monetized fiscal deficits or whatever the case may be, but you have impacted corporate margins, that could certainly be an environment where non-corporate assets, basically monies like Bitcoin or gold, or in some cases foreign equities, could have a cycle of pretty significant decoupling from some of the American counterpart equities, because they're the ones kind of swimming in these tariffs. So I view it as highly disruptive. One of the kind of the offsets to inflation over the past 30, 40 years, part of what fueled lower interest rates was globalization. And globalization is in some ways more fragile, but it's more productive. So as long as entities are not arguing with each other, that tends to be a pretty productive way of doing things. There are winners and losers from that, but on average, there are more winners than losers. And so this is like a trend change where I think we're entering a more protectionist environment. Even if some of this gets dialed back, I don't think it's going away entirely. And I think that certain kind of international relationships are persistently changed now, because of some of these decisions. And that, again, that's good for neutral reserve assets more so than assets that are entirely kind of belong to one country.
Yeah, I mean, on some level, you look at it and you think, yeah, this is what you would want to do if you wanted to undermine the dollar internationally, if you wanted to make the world not use the dollar as the global reserve currency. But at the same time, it's being combined with the rhetoric of we want to enforce the dollar. We want to continue to make sure that the world uses the dollar. We're going to stop other countries from switching away from the dollar. So it is pretty enigmatic, and I've come to the pretty solid conclusion. I mean, I could be persuaded otherwise, but I'm pretty solidly convinced at this point that there is no genius master plan. There is no 4D chess driving this. This is as ridiculous as it sounds. You keep trying to think maybe there is some kind of clever play here, but no. I mean, it's just had the tariffs actually gone through, it would have been massively devastating. The fact that they're still hanging there, I mean, I shouldn't say massively devastating. It wouldn't have been as bad as COVID. It would have It would have been expensive. It would have cost a lot of people their jobs and ruined their livelihood and raised prices a bit here and there. But it wouldn't have been something as bad as COVID. But it's not something that is good. And I think this kind of idea that you can just play with markets and crash stocks to prop up bonds and then lower the borrowing costs for the government. This is the stuff of third world banana republic finance ministers and their creative ideas, which sound amazing for the first 6 months before they have to flee the Ministry of Finance by helicopter and then catch a private jet somewhere where they can access their Swiss bank accounts. It's one of these. It's one of these things where people just start thinking too much of the macro economy as if it was a private business, and thinking of it like a CEO can turn around a company, and it's not. I think the ultimate problem is from my perspective, it's from the Austrian perspective, it's that the issue of economic calculation can only be done with private property. And so the government is in no position to be negotiating on behalf of others who own their own capital. So if the government is deciding for your business that you're going to start paying 140% import tariff on goods from China, they're not performing that calculation from the perspective of somebody who's managing your business, because they don't own your business. And the notion that they can just make these plans for everybody, I think, is highly, highly damaging. It might make, I can see how it would appeal to somebody who works as a CEO to think that you could negotiate on behalf of the entire country and then strengthen the negotiating position of everybody in the country. But in reality, it's millions of people negotiating with millions of foreigners, and you're not helping by just coming in and scrapping everything that they've agreed to and throwing it in the garbage bin and telling them, let's start all over again.
I agree. It's been interesting to watch. I mean, basically, I was from the beginning, I was fading this view, but there was this kind of honeymoon period where there are a lot of people that are like, no, maybe they will reduce the deficits, or maybe this trade thing will, work out. But I've been bearish on that. You've been bearish on that concept that it's going to be effective. If you look at the interesting thing is any administration, there's kind of multiple voices within the administration, like multiple camps that are all trying to basically get the administration to go in their direction versus the other one. The classic example of like a king and then his advisors around him kind of pulling him in one way or another. And in this administration, there's the side that kind of laid this out the most articulately. If you were to see if there's an attempt at a master plan, they kind of spelled that ahead of time, which was like basically Stephen Myron, that's Trump's chair of the Council of Economic Advisors. He published an academic type of paper in November 2024, so after Trump was elected, and it kind of said, if we were to reset global trade, how would we do it, and what are the risks associated with it doing it? So it wasn't like this kind of political piece. It was kind of this like more analysis type piece, and it was kind of the steelman version of what they're trying to do. And I think that the critique I would give of that paper, having read it, is that it kind of made too many generous assumptions about the US's leveraging, like position in terms of the leverage that they have in these negotiations. The view was, okay, we ramp up tariffs, that'll squeeze many of our trade partners, it'll strengthen the dollar, and then we'll be able to make trade deals with them that are more favorable to the U.S. than they are now. That was like kind of their written plan. And then there are other parts of that paper too that were relevant, and they kind of said, okay, well, after that kind of first wave of hard negotiation, once we do make these trade deals, then maybe we can do some sort of like Mar-a-Lago accord to purposely weaken the dollar compared to other major currencies. That can allow kind of a global trade boom that can reduce U.S. Trade deficits. And they were like, okay, but here's the problem: is that can be inflationary for things in dollar terms, and it can result in higher bond yields. So how do we offset that? They were like, well, as part of our negotiations, we can try to get foreign countries to term out their debt, basically get them to. It's basically an analysis of how we can get more bag holders. And I think they overestimated how much bag holders they'd get. They seem to assume that a lot of countries would agree to be bag holders in exchange for, one, being under the U.S. military umbrella, and two, being able to access the lucrative American market. I think they overestimated the value of those two things to a lot of, especially the major BRICS countries. It's easy to push around a country that's got, say, 50% of its trade with the U.S. and it's like 1% of U.S. GDP. They kind of assume that they have that type of negotiation position with the world. Whereas when we look at the Chinas, the Brazils, the Indias, big blocks of countries that have a lot of trade ties, I think they overplayed their hand. And so that's kind of, I think, the Steelman attempt of what they were trying to do. But then even within administration, there are other parts that were either disagreeing with that or modifying that, and the result is messy.
Yeah, no, I agree entirely. I think driving this is a misconception about the size of the U.S. economy and the size of the Chinese economy. I think there's still this conception of China as being China in 1995, and I think a lot of the rhetoric around China is that it is this totalitarian hellhole that is going to collapse. But ultimately, I mean, look around you. The majority of the most advanced goods in the world are being produced in China. And that's just not something that happens in a massively dysfunctional society that is on the verge of breakdown. It's not really possible to be at the forefront of technology while also being completely as weak as I think a lot of these Americans imagine. And at this point, even for China, I mean, the volume of trade that China has with Southeast Asian countries, the ASEAN countries, which is 10 countries with a population of about 700 million people and a significant economy. I mean, 700 million people, their economy is roughly the size of the EU, or maybe a little bit larger now. So this is a huge trading bloc for China. It contains Vietnam and Thailand and Malaysia and Indonesia and the Philippines. And so this is a huge trading bloc for China, an enormous amount of goods there. And China also trades with Latin America and with Africa. And the US is just about 12, 13% of Chinese exports. I mean, yes, it is the biggest export, but if you add up all of the ASEAN countries together, and it is one free trade zone, which I think China negotiates with collectively, it's about the same size. And 13% is, it's not nothing, but it's not everything. It's perfectly possible for people to recover from losing 13% of their customer base. Drop your prices a little bit, and there'll be plenty of people all over the world who will pick up the Americans' leftovers. But I don't think it'll come to that. I think it's far too beneficial for Americans and for Chinese to trade with one another. It's just economic suicide. I mean, it's not suicide. I don't think it'll be catastrophic. I still think nature and markets will find a way. People will smuggle those things. They'll assemble them in Mexico and say that they're made in Mexico, and they'll find complicated treaties where Mexico has a free trade treaty with Thailand, and Thailand imports it from China, and then Thailand sends it to Mexico, and then from Mexico to the US or whatever. Nature will find a way to route around those things. It'll be expensive, annoying, and destructive, but I'm optimistic it won't get too bad. I think they may have learned their lesson.
Yeah, I think there are several parts about China that are often underestimated because there are obviously headline things that are critiquable. Their demographics issue, their real estate bubble, and leverage that was attached to that. But then the other factors keep being either misunderstood or just ignored completely. Like one, they're by far the biggest electricity producer in the world, which is relevant for a lot of manufacturing and other types of energy production, like the raw heat needed to make heavy industry like steel. You can't just like magically teleport all that infrastructure to other countries or to the U.S. That takes many years to move, even if there are economic shifts that happen to that incentivize the movement of that. So that's an incredibly valuable asset that they have, that industrial base, the energy plus the manufacturing capabilities. There's also human capital. So there are certain hubs that are good at things. Like say in Silicon Valley, you have the VC environment and the networks of funders that they're fully ready to fund them. There's all this connective tissue there. Same thing in New York with investment finance. Parts of China have really strong manufacturing hubs. They're people that know they're like masters at supply chains. They know all the connective tissues that's there. They know all the suppliers. It's just one big, very efficient hub, and that's hard to move quickly and replicate elsewhere. And then they have people that are just have years and decades of experience of running manufacturing facilities, and all the human capital that comes with that. And then China's been moving up the capital stack. So like you said, it's not China of the 90s or the 2000s anymore. It's not the market of plastic toys. They've moved up the capital stack. So now China's the biggest auto exporter in the world. Literally in a 4-year period from like 2020 to 2024, they leapfrogged all the major exporters. They leapfrogged South Korea, the United States, Germany, and now Japan to be the world's biggest auto exporter. And that was kind of years in the making. Like a lot of things had to come together. But now they're the biggest auto exporter, and it's mostly we don't see those cars in the U.S. They're almost entirely to other countries. And if we kind of extend that longer, I think that could happen with aircraft as well. I think Boeing and Airbus could eventually get a competition from Comac. You get the ABCs of competition, and the timeline there is I think they started it, and this is all from memory, so it could be a year or two off. But they started it in 2008. In the like 10 years later or so, they were finally doing their first test flight. Then I think it was 2023 or so, they were doing their first like in-flight, like actually like deliveries of aircraft. And give that another 5 or 10 years. That's another sector that a big industrial sector that they're in competition with, especially given the problems we've seen in Boeing over recent years. So I think they're going to continue to move up the capital stack. And China's got this like hybrid model where they do make certain top-down decisions. So, for example, when the U.S. tariffed them in Trump's first term, and when the Biden administration kept a lot of those kind of protections in place, China had some top-down decisions that basically was, okay, let's divert bubble activity from the real estate sector, basically telling banks, look, stop making loans to them, start making more loans to these other, say, 10 industries we want to be more self-sufficient at. And that's this like top-down funding decision of where credit's being allocated. But then at the level below that, there's like this battle royale free-for-all of competition to see which companies are going to make the best products with that credit that's been available to that industry. So there is competition between, say, car manufacturers there, even though it's a top-down decision to say, make more credit available to the car making industry. And so you, at the end of the day, you still get that layer of competition that happens. It's just the competition's at a somewhat different level.
Yeah, I think it's important for people to update their models about what's happening in China. I think cars are a great example because I remember 20 years ago, 15 years ago, Chinese cars were the butt of jokes. They were small, they were tiny, and they even used to make knockoff cars. I remember reading an article in The Economist, and this was so long ago. I used to read The Economist. But they were talking about an entire industry of fake BMWs and Mercedes being made in China. But now, a lot of people who have been in the new Chinese car tell you that they're so much better than German and American cars. Electric cars in particular, many people say Chinese ones are much cheaper and much better than Tesla. And in terms of, you see these sort of stability on the road tests. Some of these videos show you that they're ahead of the German cars in some of these things. So it's, and the phone that you're using, the laptop that you're using, a lot of the components that go into it as well, a lot of that is coming from China these days. And most of the most advanced goods in the world have some part of them being produced in China. It's not 1995 anymore. It's a very different world, and I think the world needs China as a trading partner a lot more than it needs the US. China's main imports from the US are soy, corn, and beef. There aren't many other countries that can make soy, corn, and beef. China's main exports are electronics, and these things are much more difficult to make.
I agree, and I see it in every year when I go to Egypt. I see a higher ratio of Chinese cars on the road. I think some extent this is also just Americans on average don't travel the world as much as maybe they should, and we kind of have the luxury of existing in a bubble, whereas many other people in the world have to think about the dollar, whereas Americans don't have to think about their currency. We kind of have this bubble. When you travel outside of it, you see it more directly. So you see directly Chinese cars taking market share. So in addition to me as a macro analyst seeing this on a chart, I can actually go there and see what's happening on the ground. And it's going through a similar dynamic that South Korea went through, and like Hyundai, where they enter the market and they say, okay, we're not the best quality, but we're cheap and we're good enough now. And that matters for the lower end market that demands cars. In a lot of these countries, people still drive motorcycles and other smaller vehicles. And when a vehicle can come along and be $15,000 or whatever the case may be, and be pretty high quality, that's an entry point that people can get into the auto market for the first time, and it can compete there. And then when you get better at that market for 5 years or 10 years or more, you can move up the quality spectrum to the mid-level and then sometimes the high level. So Japanese automakers did it, South Korean automakers did it, and now Chinese automakers are pretty well along. And in terms of sheer numbers, they're already number one. And I think they can over time take more and more of the high end as well. They're competing in industrial equipment, so excavation equipment, train technology, and like I said, aircraft technology. And so I think that, yeah, they're going to continue to be a force to reckon with, despite any demographics challenges they have, and despite other issues. They're a big force. And you mentioned ASEAN, so Association of Southeast Asian Nations. I covered that in a recent report too, which is they basically had this announcement. It was them plus three, so plus China, Japan, and South Korea. They're not part of that, but that are associated with it. They basically got together and said, we're a giant trade bloc still. We're reiterating it in the world of tariffs. And if anything, we're leaning into it more. And that's relevant. That's a huge share of the global economy. And then there's there's the Shanghai Cooperation Organization. There's BRICS Plus. There's all these international associations for all these other trade networks to kind of work together to say, okay, well, you have food and energy, we have technology. Let's make sure our trade links are open. And so, yeah, I think the U.S. is in a weaker position going into this than some of the hawkish takes were, and there's always a disadvantage when it's better to, like, sometimes I'll say this and people are like, aren't you pro-America? Like, shouldn't you? And it's like, well, even yes, I'm pro-America, but part of being pro-America is like understanding the other side properly. The worst thing you can do is underestimate a so-called opponent. Now, whether they're even opponents is another like matter, but let's say they are.
That's even worse than underestimating them, is thinking they're an opponent when they're not.
When they're not, yeah. And then two, it's like, okay, let's take their framing and say they are. Well, the first step you do is don't underestimate them. Know all their strengths, and then see if your plan still makes sense. So that's the world.
Yeah, I mean, there's this extremely compelling meme that keeps doing the rounds of Chinese Premier Xi Jinping just sitting there, and the meme says, "Does nothing, wins," and it seems to be playing out at this point. They really don't have to do anything. The U.S. is just it seems to be adamant on shooting itself in the foot and to pretending that it is in some kind of giant fight with China when China is just out there trading. They're not. They're really being a lot more cooperative internationally than the U.S. I mean, they haven't fired a bullet abroad in 40 years. They've not intervened militarily anywhere. And the US, on the other hand, has just been fighting war after war after war all over the world, and somehow is trying now to convince itself and the world that China is a massive threat to it, like all the other threats.
Yeah, and I think it's funny because that do nothing meme. I think that one of the advantages of planning ahead is that by doing things early, it makes it seem like you're doing nothing later. So they did have a flurry of decisions they made back, nearly a decade ago now, when the U.S. got increasingly protectionist against them the first time. They basically did an analysis and said, where are we vulnerable? Let's invest heavily in those areas for the next X years. And they did pretty aggressively. And so as we then accelerate the protectionism, they've got the fruits of prior investments now. That they said, okay, well, if we get cut off from key semiconductors, to what extent can we replicate them here? If we get cut off from XYZ, and how can we make them here? And just shoring up defenses as much as possible to avoid kind of asymmetric issues. And so because they did a lot of that, now it's able to look like they're not doing much, because at the current time they're not. They're just kind of reestablishing their existing communications. So yeah, I think we're in a different world than we were 10 years ago, 20 years ago. And trade's going to keep flowing, and the U.S. can kind of choose how much frictions it builds around itself. And part of it, I think, is education, because people can, if a lot of people get convinced of something, then it can go in that direction, even if it doesn't make sense. And so one thing I try to do is just my little part of just putting out research to say, hey, here's how I see things. Consider this before you get rallied up on something. To the extent that one person can impact anything.
Well, that's also why I do it as well. So I guess there's more than one of us out there. I mean, hopefully, yeah, ultimately, stressing about all of these things is nowhere near as productive as just getting into Bitcoin, joining the orange revolution, stacking sats, and building the new world that you want. And I think this is ultimately what's going to make a difference in the world.
I agree. And it's open source, so people can jump in and build without permission in most cases. So basically, we've existed in a world of kind of centralized money. We need permission to even build on top of it. And now we have open source money that people can permissionlessly build on. And if their jurisdiction doesn't let them, in many cases, they can move to another jurisdiction and build on it. And we've got these really strong building blocks to route around a lot of these frictions.
Absolutely. All right. Well, Lyn, I want to thank you so much for your time and insight. Always a pleasure. Thank you so much for joining us.
Thanks for having me back on.
All right. Take care.